Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is September 5th, 2025. I am Luna.
I am JPMorgan.
We had record highs,
Right.
right, across the major U.S. indexes, and it was primarily fueled by these shifting expectations about the Federal Reserve. So we'll try to connect the dots for you from the labor numbers, these political surprises, and the key global signals, sort of a shortcut to getting up to speed.
Okay, let's dive right into those numbers then.
Yeah.
U.S. stocks rallied pretty much across the board. S&P 500, Dow Jones, Nasdaq Composite, all climbing nearly 1%. And hitting new peaks, too. So what was really the engine behind that surge?
Yeah.
Especially when, a quick look at some of the data might suggest, well, something different.
Yeah, that's what's truly fascinating here. The gains were, somewhat paradoxically, sparked by weaker U.S. labor market data. I mean, new jobless claims, they rose to 237,000. That was above the 230,000 expected. And private payrolls, they only added about 54,000 new jobs in August, missing the forecast of 65,000. So this signaled, a cooling in employment growth. And for the markets, that reinforced hopes the Fed might actually ease policy sooner rather than later.
Right, the classic bad news is good news scenario for rate cut expectations. It still feels a bit counterintuitive sometimes, though, doesn't it? I mean, while the market cheered this weaker data, isn't there a point where job weakness stops being good for rate cuts and starts signaling a genuinely struggling economy? How does the Fed even walk that line?
It forces us all to constantly recalibrate, doesn't it? How we read these economic signals. Traditional logic often gets flipped on its head by central bank expectations. And yes, you had New York Fed President John Williams' comments, which really solidified that view. He indicated that gradual rate cuts could be appropriate if inflation eases and unemployment ticks up modestly. So this pretty much cemented market expectations for, say, a 0.25% cut at the mid-September meeting. And you saw that reflected in yields. Short-term Treasury yields fell. The 10-year, meanwhile, it sort of hovered around 4.17%. Impacted not just by Fed talk, but also global stuff like Germany's new budget plans adding supply.
Okay, interesting. So beyond equities, how did other assets react to this whole mix of macro factors and Fed hopes?
While commodities were a bit of a mixed bag, you had oil prices, WTI crude specifically, dip about 0.2%, down to $63.35 a barrel, actually heading for its first weekly loss in 3 weeks. And that was largely down to a surprise build in U.S. crude inventories, about 2.4 million barrels, plus some chatter about OPEC plus maybe boosting output. But in stark contrast, gold prices surged, really pushed towards record highs, around $618 an ounce. Gold's surge isn't just about safety, though. It's also, I think, a pretty powerful signal the market's pricing in lower real yields for longer. Makes non-yielding gold look more attractive, And even Bitcoin held up near its recent highs, around the $120 K level, sort of mirroring that broader risk-on mood.
Right, but then amidst all these sort of expected market moves came something a lot conventional, potentially significant, too, from within the Fed itself. Tell us about that political shock. I mean, beyond the immediate headlines, how does something like this really test the Fed's institutional integrity in the long run?
Well, it definitely raises an important question about Fed independence and governance. You had the U.S. Justice Department opening a criminal probe into Fed Governor Lisa Cook for alleged mortgage fraud. Now, the immediate market impact seemed limited, but it does introduce these concerns about governance, credibility, and that could indirectly at least demand a bit more risk premium in longer-term U.S. bonds. Basically, investors might want slightly higher returns to compensate for this new layer of political uncertainty. Even if the immediate financial fallout is contained, it really forces you to ask just how robust is that political firewall around the institution.
Definitely something to watch. So looking ahead now, what are the absolute critical releases for you, our listener, to keep an eye on in the coming days?
2 key ones, I'd say. First, on September 9th, the BLS releases its preliminary benchmark revision to non-farm payrolls. This is an annual adjustment, and it could potentially show that job growth over the last year was maybe overstated, which of course would further strengthen that case for the Fed easing. Then, overnight into September 10th, we get China's August inflation data, both CPI and PPI. And given China's role in the global economy, any unexpected deflation, or conversely inflation there, could significantly move global commodity prices and overall risk sentiment too.
Okay, so pulling it all together,
Oh.
what does this all mean for you? It's clear markets are juggling multiple narratives right now. You've got monetary easing hopes driven by those Fed cut expectations, hints of fiscal expansion like Germany's budget impacting global bonds, and now this political risk factor at the Fed itself. But the dominant story, for now anyway, seems to be that potential policy pivot towards stimulus, which is supporting risk assets.
Absolutely. That narrative is strong right now. But you have to remember, a single contrary data point, maybe an unexpectedly strong jobs report next time, or an inflation uptick could quickly alter that outlook. Which really raises an important question, doesn't it? How prepared are you for a potential shift in this prevailing sentiment? And, well, what does that mean for your own strategies going forward?
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.